welcome to the special show as we count down to Budget 2024. All eyes are working and looking at July 23rd is when the Finance Minister will unveil the full budget. Well, this show will focus on what your budget strategy should be if you're a short-term trader, medium investor or a long-term investor. To begin the show, we have to take you through what those previous budgets have done and how the markets have behaved in those conditions. Since 2010, there have been 17 budgets. 14 were full and 3 were interim budgets. The average return 1 week prior to the budget has been 0.45% negative. And this time around, remember, the markets have already rallied sharply in the last 20 trading days. The Nifty is up over 10% in the last 20 trading days as indicated. Now, does this call for profit taking or does it call for initiating fresh long positions? Chandan Taparia, Head of Technical and Derivative Research at Motilal, joins in. Hi, Chandan. Thank you for taking out the time to talk to us. If we look at historical data, the 1 week prior to the budget being announced is usually negative, flat to slightly lower. This time around, we're going into the budget with significant gains. The Nifty is up over 10% in the last 20 trading days. As we gear up, some may argue that there is a little bit of fatigue that the markets are showing. But between now and 23rd of July, how would you position a trade on the Nifty?
Yeah, thank you, Samina, for a fantastic question about the market and the budget ahead. If you look at the overall sentiment of the market, the trend is intact to positive. I believe the budget is going to be on 23rd of July, and because of that, the volatility might see some spurt. That is the first thing we need to keep in mind. The India VIX, which was at 32 at the time of election result, has corrected from 32 to sub 13 levels. But we believe that because of the budget, volatility might see some spike and it can head to our 16 to 18 zone. But if you ask about the market setup, the major trend is positive. And because of any trigger, if volatility happens, I think that will be bought. Because the structure of the index is quite positive and we have seen the sector rotation and selective heavyweight stocks are doing well. At the time of elections, the index drifted all the way to 21,280 kind of level, but we witnessed a recovery of more than 3,000 points in just 23-24 trading session. So that clearly indicates that liquidity is there in the system. FIs also covered their short position. DIs are continuously buying. SIP flow is more than 22,000 crore per month. So if I combine all the data setup internal and even considering the previous couple of budgets, I believe the market has higher base. Major support for the index goes as 23,500. With this support, any small decline to us 24,000 could be bought. And overall, we are looking for an upside rally to extend to 25,000 marks. So I believe 23,500 to 25,000 will be the wider range with positive bias, and any decline could be bought in the market looking at the next event.
Right, just taking a cue from that, Chandan, in that case, of course, traders can initiate naked positions on the long or the short side, keeping the range in mind. But I would imagine an option strategy may be better direction agnostic. Do you feel like butterflies, long strangles, straddles could be a better way to play the budget trade between now and then?
Yeah, I think trading an option will be more advisable or better advice comparatively, because yes, event is there, so we can't ignore the volatility which usually happens at the time of event. But we need to keep two things in mind. First, whatever the strategy we want to deploy, we will go with some directional to play the delta drifting. Second, your volatility is not spiked up. As of now, we are at 13.6. So we have to look at the strategy where we get the benefit of the Vega spike before the event, and after the event, the volatility will again go down. So I'll go with bull call butterfly with the view that some positive upside will be there. But again, 2 or 3 factors are there which are keeping us to think about the restricted upside. First, your RSI has gone to 70 level. FI's long short ratio has gone to overbought zone of 88. But yes, momentum is positive. That's why we are not changing the stance. We are being positive, but now the view is positive to range bound. So now what we can do, we can buy 24,300 call. So we can buy one lot of 24,300 call. We can sell one lot of 25,000 call, and we can sell one more lot of 25,500 call. So we are initiating 700 plus 500 points bull call ladder or bull call spread, or we can convert into the bull call butterfly. So the aim is to get some positive move without getting hurt from the theta decay, and that is the reason we are selling out of the money also. But again, budget is there, so we don't want to pay more, we don't want to take more risk, so we can hedge as well. So two types of strategy or three types of strategy we can advise. First, buying at the money call, selling 700 points OTM call, that is called bull call spread. Then sell further 500 points more OTM, that convert to the bull call ladder spread. Otherwise, if someone is looking for butterfly, buy 24,300 call, sell two lot of 25,000 call, sell and buy one more lot of 25,500 calls. So this is how you can initiate the strategy with the view that view is positive to range bound. But yes, there are many people who believe that market has already seen the good run up. Even in this year, the index is up by around 11-12%. Many mid cap, small cap, heavyweights counter has rallied well. And whenever there is the event, we always think about the hedging activity. So those who are looking for hedging, they can buy 24,000 put and sell 23,000 put. So one can create the hedge of 1,000 points. Even we are not expecting it to go below 23,500, but hedging is always advisable in the market. So view is positive to range bound, but at the same time, we also advise to go for some hedging activity with the view that we want to mitigate the risk and we want to maximize the return in the market.
Right, Chandan, these are times of uncertainty, and historically we've seen that the period before the budget turns markets quite volatile. And just a quick follow-up before I go to Feroz as well, at the fundamental view on what the expectation of the budget is. What sort of expiry or time horizon would these trades or should these trades be, Chandan, for July 23rd expiry, or would you say that running it for the full month may be advisable or probably more profitable?
Yeah, so we'll go with monthly expiry. 25th is the monthly expiry for Nifty, 24th is the monthly expiry for Bank Nifty, being Thursday and Wednesday respectively. So I'll go with monthly expiry of 25th of July for all these trades.
We also have with us Feroz Aziz, Deputy CEO at Anand Rathi Wealth, joining in. Hi Feroz, thanks for joining in. It's Amina. It's been exciting. The last few weeks, the last few months have been exciting, but let's not forget, after many, many years, this is the first budget that a coalition government is going to be unveiling for us. From somebody who's tracked so many of these budgets historically, what do you think is the expectation today? What is a wish list from a market participant and from somebody who advises long-term investors?
Good afternoon, Samina. To my mind, like you rightly said, this is the first maiden budget of this coalition government. Of course, it's not like a pure play coalition government because the majority, of course, the 272 mark was not crossed, but I think it's still a powerful government. So I personally, from a capital market standpoint, have three expectations, not from a tax standpoint, but from an economy standpoint. The first expectation is the fiscal consolidation should continue. That's first expectation. The second expectation I have is the capital expenditure implementation of the 11 lakh odd crores, which is 11% growth. That should happen efficiently. That's the second expectation. The third expectation is the last term, the disinvestment targets were not met. But this time around, I hope the disinvestment targets get met. 36,000 crores is what was the average disinvestment as against 65,000 crores, which was targeted. So these are the three broader expectations. But from a fiscal consolidation standpoint, if I dwell deep into it, I personally think that the fiscal deficit targets are being met, and actually not first time ever, but very few times have we kept our fiscal deficit numbers down by 1 lakh crores, which I think is brilliant. The tax collection on the GST side, the growth has slowed down, but the direct tax collection is expected to grow at 13%. So that should support fiscal consolidation. I personally think prudence with respect to fiscal deficit is very critical for the FIIs to see this economy as a far more positive economy over the next 10-15 years. And that, I think, in this term has to get more and more established and reinforced for foreign investors to become more sticky, unlike the last few months.
Right. Feroz, I'll spend some time talking about capital expenditure because I think that's going to be very critical for the markets. But just before I go into that, there was that bumper dividend payout by the RBI. How do you feel this money is going to be used and spent? Is it going to have a significant impact on reduction in market borrowings, you think? And hence, that then has a follow-on effect on the debt market and then equities as well?
Sabina, in my opinion, of course, the dividend has been 2.1 lakh crore as against zero point 0.9 lakh crore just the previous year. Of course, it's a lakh and a 20,000 crore more of dividend. And I think the PSU banks dividends have also been very good and they are expected to be good. But I don't see this as one of the tool or one of the lever which can bring down borrowing of the government. I think the net borrowing of 11 odd lakh crores will happen because the expenditure is going to grow and the budget size is going to be almost about 47.66 lakh crores, growing by about 7.3% vis-a-vis the 44.4 lakh crore, which is the provisional number so far for the last fiscal. So net, what I'm saying is this extra dividend will be cushioning the expenditure increase of about 7.3% and the borrowing of 11.5 lakh crores, net borrowing, and the gross borrowing of 14.1 lakh crore may remain, but it's still the yields will be softened because of our inclusion in the bond index. $12 billion have come from September after globally. I think another $18 billion is expected. So I think the yields in the long end of the yield curve may not rise in spite of the borrowing remaining elevated, given the fact that RBI has given a larger dividend, but I don't expect net borrowing to come down, Samina. And I think it's a brilliant question, and that's what the debt market is looking at.
Firoz, the space that's been most excited ahead of the interim budget, ahead of the elections, and now, of course, the final main budget has been PSU stocks. And when I say PSU, specifically mean railway, defense, and fertilizer. It's been so tough to read what these stocks are getting up to. And of course, Chandan may have a better idea on the charts. But fundamentally, do you feel like the markets are getting ahead of themselves in terms of expectations? Or do you feel this budget is going to be all about growth, development, and sectors like defense, railway, and fertilizers?
Yes, I think they have definitely from a valuation standpoint, and if you look at that as the dimension, of course, they've gone ahead in terms of what valuations you would want to give these companies and these sectors, definitely ahead of time and ahead of earnings for sure. But second point is, I think these stocks, free floats have already been gobbled out, and I think the free float available for people to grab is very low. That's why every unit of rupee invested in these stocks is resulting in a re-rating. Unless this liquidity cycle gets broken, I think this whole fundamental being looked at is going to be a far-fetched thing. So we are tracking the liquidity in these sectors very closely. Like if you look at the SBI Infrastructure Fund, which is the largest AMC's infrastructure fund, I look at its inflows every day. Unless this inflow, like yesterday, there was about 100 crore inflow, 75, 80 crore inflow, if I'm not wrong. So what is going to happen is, unless this cycle of liquidity breaks, fundamentals will not be looked at. So the focus will shift as soon as this starts taking a breather. So we at Anand Rathi, we've been very clear, be the broader market or be these hard sectors, we would be the first ones to pass the pillow as soon as the tide of liquidity turns, and then the fundamentals take the primary seat in terms of the valuations. I think till that happens, I think I would be ignoring valuations for some more time, maybe a couple of months or 6 months, or even as latest as 1 week later. If the liquidity dries up, reality will sink in.
Well, no one knows whether reality is valuations anymore, right? I mean, it just seems like they're in a little bit of a unicorn world in that sense. Chandan, how do you feel about it? You know, historically, we've always seen fertilizer, railway stocks do well ahead of the budget. This time around, you've got defense names. In the last 2 years, they've been such an important and significant part of where money has been coming into in the broader markets. Today is no different. Stocks like RVNL, IRFC, IRCTC, Railtel doing exceptionally well. If you don't, so this is a two-part question. If you own these stocks in railway and defense, what do you do? Do you take profits off the table ahead of the budget? Or if you don't own these stocks, would you recommend buying fresh or opening fresh positions in any of those railway, defense, fertilizer stocks between now and the 23rd of July?
So we have positive view on the entire Nifty CPSE index. That means it combines defense, shipping, railway, PSU banks, even fertilizers, power and energies. And we believe that most of these sectors are likely to do well given the price structure. We are bullish in the entire CPSE from last couple of quarters, and most of the sector and stock have really done well. Still, I believe the momentum could continue here. The way the flow and the sentiment, the setup is clearly visible on the chart basis. So I believe one can continue to hold the shipping name or defense name, whether we talk about HAL, BL, or counter like Paras, BDL, even in railway, positive on the IRCTC, RVNL, IRCON, positive name on most of the fertilizer names. And I think monsoon progress will also aid the momentum and the positive stance here. In fact, if you want, the couple of names from housing, finance, infra, and construction could be in focus. Companies like NBCC, Hoodco, IREDA, all these stocks will be in focus in the Nifty CPSE. Those who are holding, they can continue to hold the position with the view that further 10 to 20% run up could continue. Those who are looking to it, they can also definitely be here. I believe this sector, which has already seen the good momentum and strength is there, that is likely to continue. So one can be here, and I believe some sort of alpha generation could be seen here for the next 1 month to 3 months in the market.
Right, Chandan, sorry, I'm just going to try and make this a little more specific. So if one has to build out a concentrated portfolio on the trading side between now and the budget and pick stocks from the sectors we discussed, give me 3 to 4 names that you would add significant wealth to, because if you've got to see a significant movement, then you will have to have a relatively large allocation to these 3 to 4 stocks. So 3 or 4 stocks in the sectors we mentioned.
Yeah, so I think I've discussed a couple of sector here and stock as well. So if you want me to include the 3 to 5 name, first I'll go with HL, Hindustan.
Your top 3 to 5 stocks.
Yeah, so I'll go with HL. However, the stock has really done well, but still we have potential upside of 20-30% from current level. So one I can select from defense, that is HL. Positive view on NBCC. So here expecting further momentum. Just couple of days back, it gave a major breakout on the daily and the weekly chart, and it has potential to rally towards 250 level. So HL is the first name, NBCC is the second name. In fertilizer, I'll go with the fact. Fact has really seen the narrow range breakout on the weekly chart. Even on the monthly basis, we have seen good run up in the last month, and now after the consolidative move of 10-12 days, again some attraction is clearly visible. So 1250 kind of target could be seen here. Apart from that, when we talk about the budget, capital allocations need to keep in mind. So I cannot ignore the capital goods name, and in that I'll select the L&T with the view this is going to be the major beneficiary, whether there is a benefit in the defense or order or anything related to the capital infrastructure. So L&T will be 4th name, and one more I can select in the EV, whether you talk about Olectra or any other. So these are the couple of stocks I think one should take to play the budget theme, with the view that budget will be for India and focus will be the infrastructure, focus will be growth for the country, and focus will be on Skill India or Make in India or making defense more progressive in the country.
Right. Very lastly, Feroz, what is the advice to medium and long-term investors? Should they consider tweaking their portfolio as you go into this budget, or do you feel like while it may induce a little bit of volatility, the long-term vision and portfolio should remain the same?
I think there are 3 pieces of advice for a long-term and a medium-term investor. Medium-term, by which I mean 3-year plus. Long-term, by which I imply 5 to 6 years. The first one is your equity exposures can still be higher. If you don't have for your 5 years money is greater than 70-75% in equity, I think there is still a very important increase in allocation needed. So I would not recommend anybody to be less than 70-75% for 5 years monies into equity. Making money in debt is not going to be so easy. Even if interest rates were to come down, the long end of the yield curve will not make you too much money because it's not gone up. That's point 1. Point 2, if you have been in the broader market, which is mid cap and small cap, it is time to take some money off the table. Quite a few people have been negative from last October in terms of valuation, but I think liquidity has brought them here. I think taking some money off the table and still the broader markets will do well. But if your allocations in small caps have exceeded more than 25%, you would have to bring it back below 25% and about 20-25% in mid cap and 50-55% in large cap. I think that's the second piece of recommendation. Third, please don't put your money, long-term monies, into thematic schemes. Because the themes are very popular and diversified funds are also exposing themselves to several sectors which are actually being independently launched as sector funds. I see several retail investors buying sector funds. I think that's something which is avoidable at these current valuation levels. Looking at 3 derivative indicators, I would say the market is now grasping for breath. And that kind of rally on 4th June, of course, I was very positive, unlike most. But I think now the FII long positions have exceeded 84%. Which is a great sign of a reversal or at least a breather. So don't get too carried away with the rally which we have seen this expiry from 4th June, the last expiry from 4th June on the election.
Keep your emotions out of this. I think that's probably one of the most important lessons one needs to learn when it comes to investing in these very euphoric markets. But at least for now, the going's looking good. Thank you, gentlemen. Good talking to both of you, getting some perspective on what the market would like to see from this budget and how you should be trading and creating a portfolio at a time when uncertainty will start picking up.